The stock market just lost $2 trillion in 1 week because of Trump's new tariff announcement. And if you have money in stocks, a 401k, or retirement account, this directly affects you. Here's exactly what's coming next. Everyone is saying this is just temporary market volatility. Buy the dip, they say. Hold long term, they say. They're wrong. I'm going to show you what's actually happening and why this is different. I've been tracking tariff impacts on markets for 8 years, and this pattern is crystal clear. But before we continue, quick disclaimer, this is not financial advice. I'm not a financial advisor. This is my analysis for educational purposes only. Always do your own research and consult professionals before making financial decisions. So what exactly happened? Last Monday, Trump announced sweeping new tariffs. 25% on steel and aluminum, 15% on cars, 10% on electronics from China. The biggest tariff package since the 1930s. The market's reaction was immediate. Dow Jones dropped 2,200 points. S&P 500 lost 5%. That's $2 trillion in market value, gone, in 5 trading days. To put that in perspective, that's more than the entire GDP of Canada. That's enough money to give every American $6,000, evaporated. And if you have a 401k, you felt this. The average retirement account lost between 5 and 8% last week. If you had $100,000, you're now looking at $92,000 to $95,000. But here's what nobody's talking about. This isn't about 1 week of losses, it's about what happens next. And the pattern from history is clear. This exact scenario played out in 1930, the Smoot-Hawley Tariff Act. Congress passed massive tariffs thinking it would protect American jobs. Here's what actually happened. First, the stock market dropped 8% in the first month, just like now. Then, other countries retaliated. Canada, Europe, even small nations imposed their own tariffs on American goods. Within 6 months, global trade collapsed by 20%. Finally, by 1933, the stock market had lost 89% of its value. The Great Depression wasn't caused by tariffs alone, but tariffs accelerated the collapse. Unemployment hit 25%, businesses failed by the thousands. Now, I'm not saying we're headed for another Great Depression, but I am saying the pattern is starting exactly the same way. Market drop, tariff announcement, and now we wait for the retaliation. So what's actually happening right now? The media is saying this is about protecting American manufacturing, creating jobs, making America competitive again. That is the current political narrative, but the truth is deeper. But economically, here's what's really going on. American companies import $3 trillion of goods annually. These tariffs just added $200 to $300 billion in costs. Now, these companies are faced with 3 difficult choices. Choice 1, absorb the cost. Cut profits, stock prices fall. Choice 2, pass costs to consumers. Prices rise, inflation accelerates. People buy less, revenue falls, stock prices fall. Choice 3, find alternative suppliers. Takes 2 to 3 years. In the meantime, see choices 1 and 2. There's no winning scenario for stocks in the short term. In the end, the simple mathematics just don't work. And here's the evidence. Since Monday, analysts have downgraded earnings estimates for 73% of S&P 500 companies. They're predicting lower profits because of tariff costs. When profits fall, stock prices follow. Apple gets 90% of its products from China. 10% tariff means $30 billion in additional costs. Either Apple's profit drops $30 billion or iPhone prices increase 10%. Either way, bad for stock price. Same story for Walmart, Target, Best Buy, Nike, almost every major retailer. They import most products. Tariffs hit their bottom line immediately. Which means the market drop we saw last week, that's not the bottom. That's the beginning. Based on this pattern and current data, here's what I think happens next. This is my prediction, not a guarantee. In the next 30 days, China announces retaliatory tariffs on American exports. Soybeans, aircraft, machinery, American exporters get crushed. Market drops another 3 to 5%. In the next 6 months, earnings reports show tariff impact. Company profits consistently miss expectations. Market enters official correction territory, down 10 to 15% from peak. By end of 2026, either tariffs get rolled back and market recovers, or tariffs stay, recession hits, and we're looking at 20 to 30% total decline. The key variable is how long tariffs last. If they're negotiating tactics and get removed in 3 to 6 months, market recovers fast. If they're permanent policy, we have serious problems. And here's what worries me. Trump's advisors are saying these tariffs are here to stay. Not temporary, not negotiating leverage, permanent policy. If that's true, the market hasn't priced in the full impact yet. So what do you actually do about this? 3 things. First, check your portfolio allocation right now. If you're 100% stocks and you're close to retirement, that's dangerous. You just lost 5 to 8% in 1 week. Could easily lose another 10 to 15% in coming months. I am not saying you should sell everything, but if you haven't rebalanced in years and you're heavy in stocks, now's the time to review. Most financial advisors suggest your age in bonds. If you're 60, consider 60% bonds, 40% stocks. Second, if you're staying in stocks, focus on companies with domestic supply chains. Companies that don't import from China, defense contractors, utilities, telecom, regional banks. They're insulated from tariff impacts. Companies to be cautious about: retailers, tech companies, auto manufacturers. They're most exposed to tariff costs. Again, not telling you to buy or sell specific stocks, just showing you which sectors are most at risk. Third, keep some cash on the sidelines. If the market drops another 10 to 15%, that's a buying opportunity for long-term investors, but only if you can hold for 5 to 10 years. Don't try to time the bottom perfectly, nobody can. Dollar cost averaging is your friend. If you have $10,000 to invest, spread it over 10 months, $1,000 per month. You'll catch some highs and some lows, averages out. Look, I could be completely wrong about the timing. Maybe China doesn't retaliate. Maybe companies absorb costs better than expected. Maybe tariffs get removed faster than I think. But the historical pattern is clear. Tariffs reduce trade. Reduced trade hurts corporate profits. Lower profits mean lower stock prices. This isn't political opinion, it's economic math. The people who survive these situations are the ones who prepare before the panic, not after everyone's rushing for the exits. In 2008, the people who moved to cash in September 2008 saved their retirement. The people who waited until March 2009 lost 50%. I'm not saying this is 2008, but I am saying the warning signs are flashing. If this analysis was helpful, subscribe because this situation is developing fast. I'm posting updates twice a week as new tariff data comes in. Next video, I'm breaking down exactly which companies are most exposed to these tariffs, with specific numbers. That could be even more important than what we covered today, because it shows you exactly where the risk is. Drop a comment. Do you think I'm overreacting, or are you worried about your portfolio? Are you making any changes? I read every comment and respond to as many as I can. And if you know someone with money in the market who doesn't understand what's happening, share this video. They need to see this analysis. Thanks for watching. I'll see you in the next video with the company by company breakdown.